Solution to case 10.1. We have here the expected income 2018, and remember that it is not the budget, but we are probably in October or November, and therefore we do not have the total amount for 2018 yet. Therefore they call it expected. And the same here, expected balance sheet end of 18. So this is last year, and now we are supposed to draw up the income statement for 2019. We are told that the units will increase from 500 to 700,000, and prices are unchanged. So we changed the units to 700,000 units. At 15, it's this revenue, and the materials at 700, same price. So it's this amount, and then wages increase by 100, still 3 multiplied by 200,000, but then 100 extra, so 700 altogether. It gives us this contribution margin of 3,850. Then salaried staff and management will increase by 325, so it's this amount. Vehicle costs will be 300, we are told. The rent will be unchanged, 100, and other capacity cost 120, unchanged. So our profit before depreciation, or they call it earnings capacity, it is 1,775. The depreciation was last year 402, but it will increase by 60. So the total depreciation is here, 462. And then pre-tax profit, it is this amount. And then interest cost, it will increase by 20. So it was 48 last year, it will be 68. And then we have profit for the year. So it was our income statement. And now let's try to make the liquidity budget. We start with the profit before depreciation. It is 1,775. We take this from the income statement here. And then we have start of the year, stock of raw materials, finished goods, and debtors beginning of the year. And we pick these figures from here because we have our opening balance here 2019. So then we have to calculate our stock, raw materials stock end of the year, and it is our total use of raw materials divided by the turnover rate of 52, it's 114. And finished goods, we have to take raw materials plus wages and for the whole year, and we can find this in our here in our income statement. And then we divide by the turnover rate of 52, that's 128. Change in debtors, we have the total revenue of 10,500, and we are told that turnover ratio is 12. We give 1 month of credit, so it is 875. Here we have an increase in stock, it's a minus when an asset increases, and an increase again, it's a minus, and debtors also increase, so it's also a minus. So now we have liquidity effect from operations, 1,458. Then we are told that we are purchasing a new vehicle, it's a minus of 300. We take a new loan for the vehicle, it's 200, so it's a plus. And then the interest costs, it's of course a minus. So the total liquidity effect of the year is 1,290. We have beginning of the year 54 in liquidity, 15 in cash, and we have still not We have on our overdraft account in the bank, we still have 39 left. So it's a kind of liquidity. So these 39 plus 15, it's altogether 54. We have a positive effect of this amount plus the beginning of the year, and we have liquidity at the end 1,344. Then let's look at the balance sheet end of 19. We cannot, when we look at the total assets, we cannot distinguish between machinery, vehicles, and equipment because they did not specify on the different groups. But we had last year a total of 1,860. We can find that here. And then we have purchased 300 a new vehicle, and we have a depreciation for the year. We can find that in our income statement, 462. So our new total fixed assets, it's this amount. It's the book value of the fixed assets. Raw materials, finished items, trade receivables, we can find them here. We just calculated these figures in our liquidity budget. And then our liquid funds of 1,344, we found out here in our liquidity budget that we will have this liquidity end of the year. So altogether, we have total assets of 4,159. The share capital is unchanged. Retained earnings was last year 1,494, and we add the profit of the year of 1,245 from the income statement. So this is our new retained earning. So this is our total equity. Then our debt increased by 200. It was the vehicle loan. And then we have a total debt on our overdraft facility, 200. We take the full amount of 200 because the 39 was used here, as you remember. So now we have total debt of 720. So total liabilities is here, and now we can see that we have a balance here, so it's okay.